Welcome. Today we're going to look at the value of your business and how to maximize it. And a lot of the other talks we've done have been on business valuation principles in terms of valuing other people's businesses. And what we're going to do today is look at how we can apply that to your business. And so one of the things we're going to look at is how we're going to learn how angel investors have made massive capital gains, 10, 20, 40, 100 times return on their investment by looking at the business valuation process and how it works. And then we're going to look at how we can apply that to your business. And we're going to look at 5 simple accelerators that you can apply in your business that you need to focus on that can produce massive gains in the value of your business. So the first fact is most small businesses have no value because they fail to generate a profit in excess of a commercial salary for the owner. We see hundreds of different businesses in a forensic accounting area, and most small businesses have no value. They're basically working for less than what they could do working for someone else. Many are better off going and getting a job rather than continuing with this business, but they've put so much effort and things into it that they continue on. So that's a fact. Most small businesses have no value. So let's look at the basic valuation premise. Businesses are valued in basic terms on value. Value equals profits times risk. Now, if you want to get technical, you can convert profits to cash flow. Well, we're going to assume for this purpose that profits are equal to cash flow. And it's times risk. So if you wanted to work out the value of a government bond, then it would be, say, the interest rate that it's going to return times the income that's going to return from that bond times the risk associated with it. Now, something like a government bond is very low risk, so you're only getting a 4 or 5% return. So what is risk? Now, there's a risk of a few things. One, if you're making an investment in a business or looking at the business, there's a risk in the first instance that you're not going to get any income from this business, or investment. So it might not, the income might be lower than what you expected. So you might be investing in a business or some shares and thinking, okay, I'm going to get a dividend stream of 10% from this business. The first part of the risk is you won't actually get that income stream. So the risk that your investment won't return an income at all. But there's also another risk that you won't get any capital return. So there's a risk that you could lose your capital as well. So if you're investing in something low risk like government bonds or a simpler example is term deposits, the risk, if you've got a term deposit with a bank, the risk of losing your capital is very low. And the risk of not getting the income 5% on your money is very low as well. So because the risk of losing your capital and the risk of not getting the income that was promised is very low, therefore things like term deposits, government bonds around the 4, 5, 3, 4, 5, 6% rate. And then we look at something that is high risk, which is a startup business, where you don't know what type of you don't know whether you're going to get your money back. You don't know whether you're going to get the returns that are required along the way. And so a startup business might have an 80% effective interest rate built into it. So let's look at some of the valuation models that can be used for understanding the value of a business. Now, in this instance, we're not going through, I missed some of them for a reason because we want to concentrate on, the focus is on how your business is valued rather than what methodologies are using in the courts that we might use on an official business valuation methodology. So the first one is cost replacement. Now this is for very small business. We'll discuss this in a second. And it's just basically the cost of replacing those. And then we've got future maintainable earnings, which is used for the next group of businesses, so small businesses that we can, that are not too big. And then we look at discounted cash flow. So if we're looking at public companies or significant businesses, we're looking at a discounted cash flow methodology to valuing those businesses. And that's part of what we'll go is very simple examples of how that's used that angel investors use to make up their money. So look at the cost replacement. We look at cost replacement. We see this in cafes and small retail shops, and they're really not making a profit. And the cost replacement type model is really used as a justification for the purpose of for the purchase of a business. So we're looking at, okay, what's the cost associated to build this business to the same level? If we wanted to create a new business, what would we need to do? How many months would it take to build it to the same level of sales and profitability? And so we look at fit out, whether they've got a database or existing sales coming in. And we're looking at this as, the 0 to 50 grand range, which is where a lot of cafes and small retail shops really should sit. And the reason we don't use cost replacement in our business valuation and family law, business valuation methodologies is assumed synergies, which by the very nature are taken out of the business valuation process in a formal litigation sense. So the next one we look at is future maintainable earnings. Now, this is the most common used in small business valuations. So it's the adjusted earnings after a commercial salary for the owner times a multiple. And the earnings assumes a flat line into the future. So we haven't got this massive increase in sales or profitability. We've just basically, the common thing would be, okay, let's look at the average of the last 3 years as a guide to the future earnings. One of the reasons we use future maintainable earnings is because the information that we're getting from business owners is usually not, the financial information is not sufficient to really forecast properly what's going into the future. Most small businesses don't even do a budget or a forecast into the future. So there's nothing really to rely upon there. And so it assumes a flatline earning. So we haven't got any growth. We've just got, it's going to earn $50,000 a year for its infinite life. That's the other thing to remember about future maintainable earnings. It assumes an infinite life of the business. And small business multiples generally range between about 1 and 4. So you're looking at 1 for companies that are, it's a bit speculative and their profits are all over the place and there's quite a bit of risk. 4, you're looking at a business that's reasonably substantial. It's got some good profit. It's got systems in place. There might be some separation between the owner and the management of the business. It's not rely upon the owner. So that's kind of the range for small businesses. When we look at a multiple of 4 is equal to a discount rate of 25%. So a multiple of 2 is equal to a return of 50% on your money. And we'll see how that works in a sec. So where future maintainable earnings works on a flat line, what happens when you get the classic hockey stick, they call it, which is, and this is not field hockey, it's ice hockey, where you have a couple of losses before it hits profits. Now, how do you value the business at this point when it's got these losses in here? And that's when we use the discounted cash flow methodology. So the basic things about the discounted cash flow, it's the net present value of future cash flows discounted for risk. Now, I'm not going to go into cash flows at the moment because there's some technical things that that can be taken into account, and we're just going to assume cash flows is equal to profit for the purposes of this. And so if we looked at a simple example of $100 a year for 5 years. So we'll just put this over here. So we've got $100 a year, and the discount rate, the risk, is 30%. And so we can see that the net present value of that $100 is $244. So if we wanted to invest $244 and get a 30% return on our money, then it would be each year gets discounted along. So the money, the income you're going to get because of the risk, you're valuing $100 in 5 years' time at only $27, because there's a risk that you might not get that 100. And just to see the difference, if we increase the discount rate, so that's when we're increasing the risk, the value of $100 in 5 years' time is only $13. And so if we increase the risk associated with an investment, we end up with, say, $174. So for an investment that's going to potentially get $100 a year for the next 5 years, you're prepared to pay $174. So let's look at an example of how that applies to an angel investor and going through the startup to listed stage. So we're going to assume that someone's got this business idea and they've said, okay, we've established the structure for it and we've got this, say, a software product or something, and we think it's going to earn profits for the next 5 years, and we're going to assume that for the next 5 years it increases to, say, $3 million and then keeps on increasing up to about 8 for the purposes of this. And so in the initial instance, if someone was investing on the idea, we're going to assume it's an 80% discount rate. So it's a very high risk associated because there's a number of factors it may not occur. And then in year 2, we're going to assume that it's a startup now. So they've got some sales, they're making a little bit of money, but they're proving that people actually want their software product or the business idea that they're selling. In the 3rd year, we've got some initial angel investors come on board because they need a bit of extra capital to move to the next stage, and they're saying, well, okay, we're prepared to invest. It's proven to some extent, and we're going to get a 30% return on our money. The second round angel investors come in, and because with some more equity required in the business to move it forward, to get new customers and take it nationwide or worldwide, and so they're coming in and they've got a 25% return on the business. The next stage comes on and they say, right, we've year 4, year 5, it's actually established that, okay, we've proved the model and it's profitable and the sales are increasing, the profits are increasing, and we think we can take this public, and so we're going to have a 20% return on our money. So that's the risk associated with it. And then we're going to assume when it lists, it gets a 14% discount rate established. So let's see how this looks. And the blue line is the profits. So we can see that the profits go from 0 to 100,000, 500,000, $1 million, 2 million, 3 million. And in this model, we've got it continuing along that growth pattern out to 8 million and continuing on from there. And we're going to assume that they've been very good at forecasting their profits and they're exactly as forecast along the way. So the idea comes along and it's valued at $594,000, being the present value of all those investments discounted, or that income stream discounted at 80%. So if someone invests, let's assume that they're going to invest and it's going to cost them close to $600,000. The next year comes along and they've made the first year's budget and they've made $100,000, and the value of the business goes up to $2.8 million. The third year comes along and the angel investors come along and the business is now making $500,000 a year, and we're using a discount rate of 30%. So we're using a discounted cash flow in this, so it's slightly different to a flat line future maintainable earnings. So the business is now worth $10 million. Now someone else comes in at the second round of angel investors and requires more money, and now the business is valued at $16 million, because all we've done is change the discount rate along this path. And we've got a pre-IPO, and there's a 20% discount rate, and so the business is now valued at $24 million and it goes listed and the value is $40 million. And so what's happening for some angel investors is they're saying, well, we can just come in at this point here and invest in 10 companies that we think have got, a reasonable benefit. And then the hope is that one of them will get to this point. And basically you're just moving along this risk profile as the business gets further along. And so someone who came in at this level and invested $3 million has suddenly made $38 million from their investment. So how can we use this to increase the value of our business? And there's two ways we increase the value. We decrease risk and increase profits. So let's look at what the risk or discount rate is. Right? So the difference between small and large companies, because large companies will have, assuming they're profitable, will have a lower risk than a small company. And the first one is the dependency on owner. So that's a big one along the way. Just if someone is dependent upon the owner, then there's a higher risk associated with if that owner disappears, etc. Bit larger companies have a diversification of income streams or products. So we're not dependent on one product or one income stream or one service or one customer or, the old 80-20 rule where you're getting 80% of your income just from 20% of your clients, which is always a problem if you lose one of those clients along the way. Geographical diversification. So a chain of stores has always got a lower risk portfolio than just one store that might be a single shoe shop, as opposed to a chain of shoe shops. If the sales happen to go down in one, they quite often get picked up at another. Management and systems. So we're not dependent upon the owner, and we can technically replace the people involved. And if one person leaves, we've got systems and we've got management systems in place so that the other people can take over that. So the risk associated with disruption of business is lower. And we look at the governance and board of directors. So is the business, do they have people they can talk to and experienced minds looking at and taking care of the future business direction, or only dependent on one person? And we look at financial systems and forecasting. So a small business will generally have very poor financial systems and they'll have no forecasting. Now, one of the reasons it's difficult to use the discounted cash flow model in many businesses is they've got no forecasting. So there's no way that we can prove that they're actually accurate at forecasting their business profits. We look at marketing systems. How do we get people into the business? What systems they got for, if you're looking at a small business, they're really dependent on the owner going out and visiting people and making sure that, okay, they're doing all the sales. If you're looking at a large business, they've got marketing systems that are not dependent on that. And we might look at something like a brand. Is there something that can be separate from the entity itself? Classic example is Coca-Cola. I mean, in most businesses, the brand is the employees. People develop brand. I go quite long about the value of increasing brand, especially in small companies, is completely useless. So there's some of the factors that influence the discount rate. So there was two ways to increase the value of your business. One is through reducing risk, and the other is through increasing profits. So how do we increase profits? So the first one is we have to increase the number of leads we're getting into the business. And we're just going to discuss these in further detail. And then we can look at the conversion rate of those leads into sales. So if we've got how many people are calling us and how many people do we convert into sales? Then we look at the sales value. So one way to look at that is the average invoice value. So how can we increase that along the way? So these are the 5 accelerators that we can use to increase your business. The other one, the next one is gross profit. Now, there's many lawyers here, so the gross profit is, you probably don't show it on your financial statements, but it's the cost of providing that service. So it's going to be your employed solicitors, it's going to be the PA, the service staff, all the ones that go into providing that service to your clients, a portion of your time, no doubt. And we look at the value multiplier, which is the one we used in the valuation methodology. So these are the 5 business growth accelerators. Now I'm going to show you how we can get to those, because we're just going to look at making small incremental changes to each of the 5 business growth accelerators, and it has a massive effect on your business. So we're not looking at doing changes that are going to increase sales by 20%. We're looking at 0.5 to 1% changes in each one of those factors. And it will involve spending time working on your business rather than in your business. It's very easy to spend all the time just focusing on, okay, what can we do? Let's get this work out, rather than saying, okay, well, strategically, where should we be going in our business? And this is going to give you a methodology to think of, okay, how can we work on our business and just make small changes along the way? So let's look at a typical business situation. And we've got, in this instance, we've got leads of $2,000 a year, or 2,000 leads a year, so the people calling us up, and we've got a conversion rate of 20%. Now, that may be, what we usually find is people have, the leads are very low and the conversion rate's very high. If you've got a conversion rate of 100%, then you've got a problem and you're not getting enough leads in your business. You need to not be getting every client in that you talk to, because if your conversion rate's 100%, it means you're taking in every client that possibly talks to you. So you also need systems to measure, okay, how are we getting the leads in, who have we got for leads, and what is the conversion rate on that? And it could be a simple thing. We've got a standard form in our office. Whenever someone calls, we fill out a standard piece of paper. It goes into a inquiries book, and it's registered and goes into another system as well in terms of following up for emails, etc. So we got 2,000 leads. We've got a 20% conversion rate. So we have 400 sales a year. The next thing we can look, the third item is the value per sale. So it's the average invoice value. So if you look at that, it could be, if you're doing conveyancing, it might be, okay, our average value per sale is $2,000. We're getting 400 clients a year. It can be different for each business, but you need to establish, okay, what is the average invoice value? So the easiest way is to look at in your monthly accounts, how many invoices do we send out and what's the average? It's just quite a simple way of looking at it. So we look at number of sales times the average sale value. Now, you've chosen a gross profit rate of 50% here, which is, for the lawyers amongst you, it's probably about right. I mean, some I've seen that are lower and accountants who are lower than that. But if we take into account all your chargeable time, your employees who are working on the jobs as being part of that cost of goods sold, and looking at that gross profit figure. And so we got a gross profit of 400,000 and expenses of 350. So we got a profit of $50,000 after commercial salary for yourself. So it's $50,000. It just makes things a little bit easier, but it doesn't. It's easily absorbed into day-to-day living. It's nothing spectacular. And because the profits are low, we've got a low multiplier. So let's look what happens when we increase just the leads by 10%. So we're increasing the leads by 10%. So we've got to 2,200. We're increasing our conversion rate just by 10% to 22%. We're increasing the value per sale by 10%. So it could be increasing your prices slightly, or it could be adding some extra things along the way. And we're increasing the gross profit by just 10%. So we're getting a bit more efficient in how we work. So the end result, I've got expenses increasing by 20% because you can't increase your fixed cost at some point. And as you grow, you probably, so we've put a figure in there. So we've got a 231% increase in profit. And it enables, so we've doubled our income. Assuming you've got, your commercial salary of say 165,000, we've doubled your income. It starts to allow some time off and build up a nest egg, an overseas holiday with the family. So things are looking a bit better. And because the business is performing a bit better, it's got a better structure to it, we're looking at increasing the multiplier that we provided from 2 to 2.5. So I've got a business worth $400,000. So let's look at doing that again and increasing leads by 10%, conversion rate by 10%, the value per sale by 10%. So these are all small incremental changes. We've made some efficiencies in here. And so we've got another increase. We've doubled our profits again to $350,000. So things are starting to look up now. We're starting to build up that cash nest egg. We're looking to things to do with that extra money, real estate, a farm. You might reward yourself with a boat and a bigger overseas holiday or a new car or something. So let's look at that again and just add an extra 10% again. So we've got a 10% improvement in each one of these profit growth accelerators. And so we've got the profit now going to $650,000. And so we're now up in the top 1% of income earners in Australia. We've $650,000. It starts to be, you can imagine yourself at that point. We're starting to generate some serious money here. There's a lot of discretionary income. You're starting to say, well, maybe I don't need to work as much in this business, or you're just really enjoying things, putting away a good nest egg for the future. And we increased it by 10% again. So just small increases, nothing major. So we've got a 10% increase in leads and another 10% increase in the conversion rate. The value per sales increased and the gross profits increased because we've got more income coming in here. We've enabled us to make some changes to the way we're doing things and look at that gross profit. So now we've got a business that's got a profit of $1 million a year, 1.1. It's like winning the lottery every year. And this business, we've just assumed it's got a multiplier of 4, but at this type of level, we're starting to look at could be a higher multiple. So we've got a business of $4.5 million. So we've taken it from $100,000 to $4.5 million in just 5 years. So let's look at what we can do to increase the leads by 10%. So we're not looking at doing massive increases along the way. We're just looking at doing a whole series of 0.5% and 1% increases along the way. So the first one, generating leads is all about marketing. So what can we do? The first easiest and cheapest way to do it is referral from your existing clients. So it's a matter of asking them, oh, do you know anyone who could use this? Or we can really do it. We're looking at building up this area. We want to increase. Have you got any clients that people you think happy with what you've done? Can you refer some people to us? You can also look at that and have referral systems in place. So that if someone refers, you automatically send them a bottle of wine, or you pre-say them, say, oh, look, you're going to be so happy with our service. So right at the beginning, when you first that you're going to want to refer all your friends to us when we finish this process because it's been so good. The next most powerful, I think it's just an incredibly powerful process, is email, and this is mass email, educating your people. You've all got emails from me on a regular basis. It's an incredibly powerful service. It's using your existing customers to look at, to communicate with them on a regular basis. Most businesses lose clients and customers not because of price or product or service or anything else. It's indifference. The people haven't been communicating with them on a regular basis, or they don't know everything that you have to offer. So email's a really powerful way of doing it. There's some, in the lawyer zone, there's some more things on how to increase via email. The next one is the website. So We find our website generates us new work on a daily basis. So we're getting leads every day from our website. Very powerful process. It does take time to build that up. But if you looked at these three things together, you could increase your leads you're getting into your business by 10%, just a couple of percent. We're increasing the leads. So what we've said here is we're going to increase the leads by 200. This is the leads. This is the people who you might give a business card and follow up and put into your cycle along the way. So we can look at networking, going to a networking event or finding people who are within the area that you're practicing. So if you specialize in an area, you say, okay, who's particularly specializing in what groups are looking at, it's not very well explained. So if you, for example, if you're looking at focusing on startup companies and e-commerce companies, you might find networking groups that are talking about that and building on that. I'm a member of a couple of groups, and just through networking and going to see those people, we picked up a number of clients just from that group because there's no accountants within those groups. The typical ones of Rotary, Lions Club are always full of accountants, real estate agents, lawyers, etc. You look at direct mail. Direct mail hasn't really been used very effectively lately. I was commenting the other day that I've gone from getting a thick wad of direct mail every day to only a couple of pieces every week. So there's potential there for direct mail. Advertising, more expensive, understanding where that's coming from, how you can use that. You can use something as simple as PPC, which doesn't have which is Google AdWords. There's some tricks to using that, but it tends to get more expensive. Some of these first ones don't require a big investment. There are only a couple of things that you can do. The first one, well, that doesn't have any cost really. The email has got a slight. You can do email for about $20 a month to your existing list. The website's going to have a bit more investment. It's a bit more long term. Networking, okay, you can probably do that for a minimal cost in terms of time and maybe some dinners and a few things like that. Direct mail, slightly more expensive, probably costing around $1 or $2 per item you send out. So the advertising, we're seeing lots of lawyers targeting radio and things. I question the benefit of some of those. Question the benefit of what I don't like about some advertising is that it's not measurable. So we can't really say, oh, okay, that advertising campaign really worked because we saw that coming in. And we're going to look at something like trade shows. So what I'd like you to do is just write 3 ideas that you could increase the number of leads in your business by just 1%. So we're just saying, if you're getting 20 leads in your business a month, 10 leads, what could you do, a simple thing you could do just to increase that by 1%? So let's say you're getting 100, we just want a 1% increase. So it's, if you're getting 100 leads, we want something you could do to create 3 things that could just increase it by 1. So it could be, okay, we're going to email our clients with a discussion, with a paper about how to announcing a webinar, or it could be we've got a seminar on, or something. Seminar is a fantastic way to generate leads within your community. I know a few legal firms that run basically a never-ending session of doing business property and investments and family law, and it generates them a constant stream of leads associated with that. So 3 things that could just generate those leads. Increase them by 1 or 2%, because we're not looking at increasing it massively, just a small amount. And we're looking at 10 things of 1% each. So then we're looking at increasing the conversion rate. So we've got, someone's come to us and said, well, I've got this problem. I'm looking at buying a house. I'm looking at getting a divorce. I'm interested in your product and what you've got to offer. So how are we going to increase the conversion of those leads into sales? Now, we only want to increase it by 10% a year. So we're looking at a series of things that are only just tweak it up a little tiny bit. So you look at the marketing process. Can you move through your marketing and the process you've got, and we use our website a lot for this, a bit closer along to that sale process? So you can have a look at how you're doing there. You can look at the lead nurturing system. So a classic one for this is email. So people would come to your website, sign up for a free webinar or a information book, 10 things you should know about buying a property, and then you would put them into a lead nurturing system that would automatically, called the autoresponder, send them the next things they need to know about that business. So it could be 10 things you need to know about property purchase. We've got this deal. These are the things we're doing. So can we just move them closer along? Proposal documents. How you actually, we're working on this one at the moment, is what things are we doing we just increase it by 1% by improving the way that we send out engagement letters, or we send out estimates, or we send out that proposal for what we're doing. And can we just increase that slightly? I mean, we're looking at that increasing far more than 10% increase just from the proposal documents. So what can we do there to increase them along the way? One of the things about the proposal documents is that quite often accountants just talk in numbers all the time. So how can we get it more emotional, that really, and going to the next point, the value proposition, why people buy from you, why are you different from other people, why should people actually buy from you rather than someone else? It's what do you offer, what do you bring, another way to put it is, what's the product of the product? Okay, you're offering family law services. What's the product of the product? Okay, you're going to get them divorced. Yes. The product is you're going to be happy and better off, and it's a fantastic decision you've made in your life to get that clean break. And you've got the best advice possible. It's a moving forward with your life. You can increase the perceived value. So people don't buy on price, they buy on the value. So can you bundle things up to increase the perceived value of it? And you see this happening. So you might, if you become a client of ours, you will get a business health checklist. We'll have you can join our webinar series. We can, there's a monthly newsletter that goes out detailing how you can improve your business. So all these types of things can increase that bundle of that increased perceived value associated with it. Follow-up system. Okay. Pretty simple. A lot of people don't follow this one. Is you send out a proposal, following it up. So can we increase the proposals just by following up and say, how'd you find that? Were there any questions? When should you follow them up? Should you follow them up beforehand? Hi Bob, I'm just sending out this proposal for you. If you've got any questions, give me a call. I'll give you a call tomorrow on it once you've had a chance to look through it. Follow them again tomorrow, follow them up next week, the week after. Put them in a follow-up lead nurturing sequence, so if they don't buy, you're still communicating with them, because they might not be ready to make that buying decision at that point. They might have come to you and said, okay, well, I'm thinking about selling my house or buying a property. And you go, okay, well, this is how much, this is our fees, this is what we offer. And then they don't get round to buying their house just yet, or they haven't found the right place. And so have we got a follow-up system that follows not only the people who are going to buy, but also the people who have decided not to buy? And looking at closing that sale. Accountants are very bad at this, but if you look at, say, car salesmen, they want to get that sale down on paper, done. So what can you do to actually close that sale? And in some situations, if you look at the sale process, you actually need to be closing the sale much earlier. So there's someone coming to you and they just want to buy. You say, well, okay, let's get started. Bang, sign here, let's go. Some people miss that point or have difficulty when asking for the money or asking for that signature to get started on the process. So how can you improve just by 1 or 2% your conversion rate? So what I would like to do is write down 3 ideas where you could increase your conversion rate by just 1%. Okay, now the next thing we want to do is increase the sales value. Now, what we mean by that is the average dollar sale that you make for each purchase. So if you're selling, well, let's take this the simple example of conveyancing. So you're doing a conveyancing job. So how do we increase the average sale value of that one particular conveyance? Well, the first thing you look at is an upsell or a cross-sell. So other products or services that you can offer. So someone comes in and says, I'm looking at buying a property, going through the property. Okay, have you done a will? Have you looked at shareholders agreements with your partner that you're going to buy with someone you're looking at buying this business with? Is there other things you can do? Can you, are you allowed to do this or not, but can you bundle up and get a commission back on test reports and building inspections and other things like that? So is there something you could upsell and cross-sell along the way? The classic one is, would you like fries with that? They're just increasing it slightly just to increase that. So you can get the clients to buy more often. So part of this increase in the sale value is, okay, they're coming to you once a year. Can you do something to get them to come to you twice a year? Or can we do something that brings them in more often and offers them different levels of service? And one way you can look at that is bundling up things along the way. I think I bundle up services and products. So you can say, okay, we've got this, we've got we'll do the conveyancing for $2,000 and a will for $1,000, but if you get them both together, you can get them for $2,500. Can you bundle up other value items that may have perceived value in there along the way? So you say, okay, so we might bundle up, for example, we might bundle up your strategy meetings, your tax returns for the year, a pre-tax, pre-year-end tax planning session, and a strategic session, and all your bookkeeping up into one bundle. And that might be great for some people and it's not for others. But can we do that and increase the average, just push those people up a little bit? The other one, part 2 of increasing the sales value, is just plain increasing your prices. See this a lot. People they're really worried about increasing their prices. And the interesting thing about price is most people will argue about price because they don't have sufficient knowledge or they're uncertain about what you're actually offering. So it comes back down to this lowest common denominator of price. People don't buy on price, they're buying on value. So can you increase the perceived value of what you're doing? So how can we increase those prices? If you increase the prices, will it lead to a fall in profit? Most of the time, not. In some places, in some businesses we're looking at, people can double and triple the price they're offering and it has no effect on the number of customers. In fact, it can actually increase the number of customers because there's a higher perceived value on that. So there's 2 parts to increasing cross-sell, upsells, and increasing your prices. What I'd like you to do now is just write down 3 ways that you provide services or products that can increase the average sale you made just by 1%. So there's simple things. How can we increase that just by 1%? Okay, the 4th accelerator is increasing the gross profit rate. Now, the gross profit rate we're given here is probably more reflective of a service business rather than a products business, but we can look at a number of different ways. So for that, in your accounts we discussed before, your accounts probably don't show that you've got a gross profit. But the way to think about it, most of you here are lawyers. So, okay, who are the people who are delivering services, and we put them above the line. So we come back to the gross profit. So one way to think about it is there efficiency in doing things. So how can we increase that gross profit rate just by 5% a year? Now, these figures are very achievable in relation to a service business that's providing time-based things like lawyers, like things like that. 50% is quite common thing. So we can reduce the cost of providing those goods and services. Can we become a little bit more efficient at doing what we're doing? Can we get someone lower down to provide the value to provide the service? So does it have to be done by a solicitor? Can it be done by a paralegal? And so don't forget that we're increasing income along here as well. So we're getting more sales. So there's opportunities of becoming more efficient in what we're doing. So you can say, okay, you are just doing this one particular job. I mean, the classic one at the moment is workers' compensation claims. And the workers' compensation lawyers have now got a real cookie cutter, production line process in that. So they've increased their efficiency in delivering that service. So the classic one is systems. So we're not retraining people. This is the way we do it every single time. Off we go. Now, systems are great when you want people to do a certain thing in a number of ways. If you need them to think outside the square or produce different things, you can still have systems for establishing that. Now, we've got a system for looking at personal injury matters, for example. This is the way it goes, or a system for this is how we do tax returns, increasing the efficiency of it. And can we buy in bulk if we've got a business? So the classic example is businesses just starting out. They're bringing in a pallet load from China. It's fairly expensive because pallets, that size, plus you've got the increased costs associated with just buying with freight. Then you get up to the container size and you start saying, okay, the freight costs, drop considerably. The cost per unit increases. So, or cost per unit decreases significantly as well with extra buying power. So can you buy in bulk? You need to increase those. So what I would like to do is just write down 3 things you could do to decrease the cost of providing your services by just 1%. It could be a better system. It could be a different way of looking at, can we get someone else to do this job? Are we double handling something along the way? So 3, we're going to decrease the cost of providing just by 1%. Very small amount. 1 thing. 3 things we're going to write down. So we're looking at decreasing the risk of your business. Now, if you're going through the first 4 of these business growth accelerators, then you're starting to reduce the risk, because we're reducing the risk, the fluctuations associated with this business. We're actually moving up rather than a downward or a bouncing up and volatile type profit situation. So things that decrease risk: systems, operational, marketing, financial. Have we got systems for these things? So when someone's coming to look at buying a business, and you say, well, this is the system we've got to use. This is how we put people into this system and out the other end. You look at franchises are classics for that. Here is the system for creating this business, McDonald's franchise or Boost Juice or whatever it happens to be, Baker's Delight. Here is the system for making bread. So can we get a diversification of products, services, and customers? So when we start building something out there, now this is something that you probably, is the main issue here in decreasing risk for most businesses. Rather than saying, I'm going to go off and get all these different customers or different products and services to do it, it's really the main one is customers. Are you reliant on 1 or 2 customers along the way? That's the main difficulty you got there. So if you're reliant on one customer or a series of customers, that's the problem there. So financial forecasting, what type of forecasting have you got in your system? How are we looking at, if someone come in and said, where are you planning to go for next year? Well, here's how we're planning to go for the next 5 years, and this is the budgets we did last year, and we're performing to those budgets. Most businesses don't have any budget system, so a simple way is looking at the forecasting and the budgeting. You could also go on from that and say, okay, how's our financial statement looking? For so many businesses, they can't tell you what profit they've made. These days, with products like Xero and online accounting product, you can get real-time accounts, so you can tell exactly what your profit is on a daily basis, not a 3 months behind, 6 months behind, a daily basis. It's made a major difference to our business and how we provide services, because now rather than saying, oh, okay, well, last year or a year ago you made a $10,000 profit. These are the things you could do, and that's, well, it's so far away and their accounts were so bad that you spend all your time fixing up junk and people's problems rather than focusing on where they're going in the future. And so where we're going for now is actually taking all that away from customers, from our clients, and saying, look, you concentrate on doing business, we'll take care of all the bookkeeping and financial things, and we can then give you real-time accounts and we'll work with you on a strategy for building this further. So can we got a management team in place? This is just dependent on one person, or is it everything in your head, and how can we diversify and bring people up that could be management-wise? A board of directors or a board of advisors is a good way to start. So, okay, have we got a monthly meeting that says this is what we're going to do, and looking at things? So these are the things that are decreasing risk. And the major one is, can you retire from this business? Can you step away from it? What things you could do? So what I'd like to do in this instance, just write down one thing that you could do to reduce the time that you spend working in your business, so it enables you to spend more time either away from the business entirely, so you can spend some time working on the business. So it's something that you hate doing. You think, why am I doing this stupid job? I should just give this to someone else, and that frees me up. It could be as simple as, I no longer need to organise this meeting, this team meeting. Can we do something so other people can do it? So just one thing. Okay, so what we've shown is how you can take a business that was worth $100,000 to $4.5 million in 5 years, just by making a series of small incremental changes. Nothing big. There's nothing major in this. This is not saying we're going to do this massive advertising campaign. This is small incremental changes that we're just looking at increasing our leads by 10%, increasing the number of people that we convert from a lead or inquiry to a sale by just 10% a year. So we're doing many little things that can increase that along the way. We're increasing the value per sale, so the average invoice value. How can we increase that along the way? Just by 10%. They might increase your prices by 3%, and then you've just got to get the 7% from somewhere else. How can we increase the gross profit of our business by just 10% a year? So from 50% to 55%. What things can we do to make that more efficient? What 10 things we can do would make a 1% difference to that, or 0.5% difference? Just little things. And this starts to feed together, because as you start to do these things, this would naturally increase. You've got an increasing profit. It's starting to get $1 million a year. That if business is making $1 million a year, that may be a little low. Could be, if someone's looking at buying it, and you're saying, we've got the system, then it could be much higher. So, an action plan. So we're looking at doing small incremental changes that compound to result in massive value. So what we're doing is, you've listed out before a number of different things, and one of the problems people reach is, there's too many things on the list. What I'd like you to do is look at that list that you've made and just choose one thing on that list and implement it. Just do it. Choose one thing and just say, I'm going to do that. This is what we're going to do for next week. Only one thing. And one of the things about doing lists and working out action plans is sometimes you look at doing too many things on that list. I mean, how many of you had meetings and you have a meeting of partners, get together and say, okay, all the things we need to do. You list them all out. You spend hours discussing the to's and fro's of what things. And as a result, none of them gets done because you say, oh, there's too many there. I've just hit. So just by concentrating on one thing to do, you know, it's a great thing to do in your weekly meetings with people, you know, stuff. Okay, everyone's going to choose one thing that they're going to do. Like, it's very hard to hide behind just one thing. So we've also put together a series of packages for businesses that not only take over the accounting function of your business, but also provide monthly strategy sessions and where we look at the working on these accelerators and growing a business. So if you're interested in something like that and how we can apply that to your business, then just email me or call me. Now, I've spoken quite a bit and flat out for the last 57 minutes. Are there any questions along the way?